So investment bank Jefferies is now the only Wall Street firm that reports a year to the end of November. So they're the canary in the coal mine for everyone else. They just reported record revenue for their past year, just a hair under $3 billion. That sounds good, Anthony, but you've taken a look, and there's a little bit of a message for the rest of the bigger firms.
Absolutely,
right?
yeah. It's great to see record revenue. Now, don't forget, Jefferies has been expanding. It's been hiring bankers after the crisis. It's bought, was it Prudential Base, which does futures commissions. So they're adding to their revenue base anyway. Yeah, it's good to see it coming up. Unfortunately, if you look at their actual net income, it works out at just over 8% return on equity, which, using the rule of thumb, which we keep boring people with, 10%-ish is roughly where you start breaking even on your cost of equity. So they're still below, as are most of the investment banks out there.
Right, and this is why, for at least a lot of them, the shares are still trading below book value. And
exactly,
all these other things.
exactly.
And why there's pressure on pay and everything.
Yeah, and now Jefferies has a couple of things going through. Firstly, because it's been expanding, its costs might come down a bit next year anyway, regardless of any other cuts that they might do. So maybe they get a bit of an uptick. But also, last month, remember, they announced a merger with Leucadia, an investment firm which already owned almost a third of the firm. And there are some deferred tax assets, it's called, that Leucadia had. They lost money on some investments. They can now be used on the earnings that Jefferies makes.
So that reduces their future tax rate and makes their ROEs will look, look a little bit better.
Now, most others don't have that. I mean, they're not going to be paying dividends anymore, so that'll help as well. But most of the other investment banks don't have that, so they're stuck with low return on equity, with not much of an uptick in business on the horizon, at least. Now, Jefferies pointed out, look, our fixed income trading is a lot better than last year. And remember, Jefferies last year was really hammered by all the European issues.
Yeah, that's right. They had to do a lot of damage control, right?
Exactly. But if you look across other firms, fine, they said, look, September was good, October was okay, and then it got pretty slow around election and after the election. And JP Morgan, just a couple of weeks ago at investment conference, said, we think our FIC revenues will be down 20% in the quarter. So it's not looking great for late November and December for those firms. So you think, okay, what do we do? Well, we need to get our margins up and our returns up.
And this is everybody you're talking about.
This is everybody. So what do we do? Well, we cut costs. That means basically paying bankers less.
Cut people.
Or cutting people.
Paying them less. Yeah. And what else? All they can do is hope for an uptick in business.
Hope for an uptick in business. They can also hope that the Federal Reserve allows them to push some money back to investors after the stress test next year. But some of the extreme scenarios that the Fed is looking at are so extreme that most people think they're basically telling us there's no way you can return more than sort of a basic amount of capital next year. So it's going to looking like a pretty tough year still for investment banks, which are hoping to make a good return.
All right, we'll leave it there. That doesn't sound like the most stellar, exciting prognosis for the other Wall Street banks when they report in a month or so's time. We'll be keeping an eye on that, and we'll have more breaking views tomorrow.